Sandeep Kalra is the Executive Director and CEO of Persistent Systems, now joining us on the show. Good to have you on board, and tell us a little bit more about this acquisition of Media Agility, how it's going to boost your portfolio in the cloud space, because it is going to be EPS as well as margin accretive, I understand.
Before I take you through the EPS part, let me set you the context for you and your viewers on why we have done this acquisition and how it positions us in the bigger picture. And as you would all know, prior to COVID, the enterprises had already started their digital transformation journeys. During the COVID, these transformation journeys accelerated significantly. And the hyperscalers have also taken notice of this. They have been continuing to bring out newer services, vertical specific offerings, even at an accelerated pace, virtually every month. Now, as we look forward, all these hyperscalers, whether it is IBM, Google, Microsoft, AWS, or SaaS providers like Salesforce, are going to play an incrementally bigger role in the enterprise journey. And it is much beyond just the lift and shift that we have seen at a bigger scale in the past. Now, at Persistent, if you look at it, we already play at scale with people like Salesforce and IBM, where we are a $100 million plus player in these ecosystems. And with the recent acquisition of Data Glove, we had further, put a bigger, play on the Microsoft Azure cloud side. And so the latest acquisition is our, intent to go much bigger in the Google Cloud platform. Each of these platform providers have their own niches and their own customer base. So we are trying to be the Uber of the cloud services for our customers and prospects, and that's where this transaction fits it nicely. Now, whenever you do a transaction in the initial year, there is a certain cost of doing the transaction, and there's amortization that kicks in before the synergy revenue start kicking in. For the first year, we are expecting this to be on the EBIT side, having a 45 to 50 basis point impact, but we are very confident as we go ahead, as we bring the organization in, integrate the organization into our fabric, and take these services to our customer base. We expect this to be over the next 2 to 3 years, much more accretive to the EPS side. But having said that, the first year will be 45 to 50 basis points, having an impact on the negative side.
Okay, so what are some of the other details? I know you walked us through the acquisition, but in terms of the segments, the clients that Media Agility operates in, and what kind of geographical presence do they have?
So Media Agility is a company that is recognized as a Google Premier Partner, which is the highest level of partnership in the Google ecosystem. They come with 7 different Google Cloud specializations. These range right from migration, cloud native development, modernization, security, analytics, and so on. In terms of the industry verticals, they play in BFSI, healthcare, life sciences, media, entertainment, and gaming. Now, some of these are fairly accretive in terms of capabilities to us. If you look at Persistent's footprint, Persistent is big in BFSI and healthcare, life sciences, and technology companies. So from that perspective, they very well bolster our capabilities in these verticals. In terms of the customer footprint, they have 35 plus enterprise customers across US, India. These are the 2 main geographies, followed by UK. They have a delivery center in Mexico as well, which complements our Mexico footprint in Guadalajara. So from that perspective, overall, good value accretion, 500 plus strong cloud engineers with significant amount of Google certified capability, whether on the engineering side or the organization side.
So you have been on an acquisition spree, one can say, with about 5 acquisitions over the last 18 months. Could you tell us about the recent acquisition like Data Glove and how are you planning to scale some of these other ones?
So we had said over the last many quarters that our acquisition strategy is basically a bolt-on of, tuck-in acquisitions. And these would be in areas where we want our capabilities to be further enhanced or a geographical footprint expansion. So if you look at our acquisitions that we have done of late, so we did an acquisition of a company called SCI, which was in the banking financial services space, more specifically in payments, which is a fast-growing space in banking financial services segment. It brought us payment capabilities and brought us some 8 of the top 20 banking logos in the US. We are in the process of integrating that, and we are seeing earlier green shoots of newer wins because of that as an integrated approach between Persistent and the acquired entity. The other 2 acquisitions that we have announced of late are Data Glove, which is a Microsoft Azure focused company, and the latest one being Media Agility, which is a Google based capability acquisition. Now, both of them we are in the process of integrating. We have closed the acquisition of Data Glove. We will look forward to closing the acquisition of Media Agility over the next 4 to 6 weeks. And as we bring them in and as we integrate them, we are very confident of executing on the synergies that we believe are there between the various organizations that we are acquiring.
The overall business we got from the results of Accenture over the weekend suggests very strong demand. What are the trends that you are reading so far?
If we look at the overall demand environment, you are right. The overall demand environment is continuing to be healthy. And even if you look at our announced deal wins over the last 12 months, we have announced deal wins in terms of an ACV of $881.9 million and excess of $1.1 billion in TCV terms, which if you look at our run rate is a fairly healthy clip in terms of order book. Now, if you look at the other thing that we have been talking about in terms of our acquisitions, etc., so we have been building capabilities that will bolster us far more stronger in terms of even forward-looking market demand being good, or even if it was to plateau over the next 2-3 years, we are building a company which will be among the best in technology services, something that we have always been known for. So overall, demand environment is good, and we are building a capability that will last demand environment goes up or goes down.
Okay, that could be the impact of the numbers that have been declared by Accenture. But, if I were to look at Persistent Systems' recent earnings, you reported 30% plus revenue growth. Margins came in at 17%. How sustainable is this?
So from a revenue growth perspective, if you look at our order bookings are fairly healthy as compared to our current run rate. So that should give you a color. We don't, give specific forward-looking guidance, so I would refrain from that. In terms of margins, we will stick to our margin band of 16 to 17%. On the EBITDA side, we are looking to grow capabilities. We are looking to acquire market share in a good market condition. And as it comes to the longer-term aspirations over the next 2 to 3 years, we do hope to use all the levers that are available to us operationally or through revenue growth to go up the margin chain by about 2 to 3% over the next 2 to 3 years.
What exactly are these margin levers? Can you tell us more about it? Because, we still continue to hear that attrition remains at elevated levels at record highs.
So there are certain headwinds and there are certain tailwinds in any industry at any point in time. If we look at the headwinds today, attrition is one of the headwinds. What is happening in Russia, Ukraine will put further pressure on Indian talent. That's another headwind. There are, inflationary challenges, whether it is in the US or other parts of the world. But at the same time, if you look at the positive side of the equation, if you have good capabilities, if you are at the front end of digital transformation, your pricing power is better than commoditized services. So that's where a company like Persistent, which is a more specialized technology services company, has a little better pricing power. We also are seeing customers amenable to rate increases as they understand the inflation, for example, in the US is at a 7.9%, which is a 40-year high. Similarly, in other places, wherever we have gone to our customers, we have found them amenable to do rate increases over a period of time. And as our revenue increases, certain costs get defrayed over a much bigger revenue, and that gives us a margin leverage as well. We believe we are well, invested in the growth, and with time, all of this will pan out very well for us. And not to forget the ESOPs that we did for 80% of our people. As we increase in our revenues, as we enhance our performance, those will become very meaningful for our employee base. And that will also, compare to our competition, put lesser pressure on the wage hikes for us over the longer period of time.
And question is whether or not going forward, the acquisition spree is going to continue. What else is in the pipeline?
So as far as acquisitions are concerned, we'll go on a little diet for now. We have done multiple acquisitions over the last 12 plus months. We have committed to more than $220 million in capital over the next few years, a combination of certain amount upfront, certain amount in earnouts and retentions. So we believe for now, we will take a little pause. We may opportunistically look at something in Eastern Europe, which we had always said would be a strategy, but that would happen over the next 6, 9, 12 months. But outside of that, our first task is to take whatever we have acquired, integrate it well, bring the synergy revenues, and have a very healthy revenue growth. So for now, that is where we are.